7 signs. You've already reached the point of no return without knowing it. The phrase point of no return sounds like something you're supposed to dread, a line you cross and can't walk back from, a threshold where it's too late to fix anything. That's how most financial content uses it, as a warning, a deadline, a reason to panic if you haven't done enough yet. But that framing has the whole thing backwards. The point of no return in investing is not the moment things go wrong, it's the moment things become structurally difficult to stop. And what goes difficult to stop is your wealth growing. The point of no return is when compounding has built enough gravity that it pulls the portfolio forward faster than any single bad decision, any one bad year, any stretch of frozen contributions could pull it back. It's when the math takes on a life that your behavior no longer controls. Most people picture this as a distant event, a reward somewhere in their late 60s after decades of sacrifice. What almost nobody tells you is that the early signals, the quiet indicators that you are closer to that threshold than you think, show up years before you ever see a balance you'd call life-changing. And most people are walking past those signals every month without registering them for what they are. That's what this video is about. Not the cliff you're trying to avoid. The 7 signs that the ground has already shifted under your feet, and that the compounding you've been waiting on is closer to irreversible than you know. I want to give you an image to hold for the entire length of what I'm about to walk through, because it reframes everything else. You've seen what a tree looks like above ground, the trunk, the canopy, the branches that catch wind and hold fruit. What you never see is the root system. A mature oak can have roots spreading 40 feet in every direction, reaching twice as deep as the tree is tall, anchored in ways that no storm can dislodge in a single season. But here's the thing about how that root system develops. For the first several years of a tree's life, almost all of its energy goes underground. The sapling looks small, unimpressive, fragile even. A bad summer can set it back, but quietly, invisibly, the root mass is spreading. And at some point, and there is a specific point, the root system becomes large enough that no ordinary drought can kill the tree anymore. The tree is not yet tall. It hasn't produced fruit you can hold. But structurally, it has already passed through something. An ordinary bad season is no longer an existential threat. The roots have it. Your investment portfolio does this exact thing. There is a point where the underlying structure, the accumulated base, the compounding momentum, the sheer size of what's working on your behalf, becomes more powerful than any short-term disruption you could throw at it. And the signs that you're approaching it, or have already crossed it, are specific. They're calculable. And almost none of the standard financial content you've consumed has ever named them. If you find this kind of analysis useful, subscribing makes sure it actually reaches you. YouTube's algorithm treats an unsubscribed viewer as a stranger and does not reliably resurface content from channels they haven't signaled interest in. Takes a moment, and it changes what shows up for you going forward. Sign number 1. Your monthly return is no longer embarrassing. This is a smaller number than you're imagining, and the reason it matters is almost always misunderstood. Let me back up. When most people are in the early years of investing, the first 5, 7, maybe 10 years, they open their account statement and look at the returns line with quiet disappointment. You've been putting in money consistently, and the number that came from market performance is, frankly, underwhelming. Maybe it's $80, maybe it's $140. You're contributing $300 a month and the market added $100. It feels like the whole thing is barely doing anything. That's not a failure of the strategy. That's a scale problem. 8% of $12,000 is $960 a year. $80 a month, that's what it is at that balance. The math is working exactly as advertised. It just doesn't feel like anything yet because the percentage is applied to a small base. Now watch what happens as the base grows. 8% of $60,000 is $4,800 a year. $400 a month. 8% of $120,000 is $9,600 a year. $800 a month. 8% of $200,000 is $16,000 a year. $1,333 a month without you contributing a single additional cent. The rate never changed. Only the pile changed. So the first sign you're approaching the point of no return is that you open your statement and the return line, the number that came from the market rather than from your paycheck, has stopped being embarrassing. It's no longer $80. It's $300. It's $500. It's starting to feel like a real number. This is not a coincidence or a lucky month. It's the root system spreading. The base is large enough now that the percentage produces something you can feel. Vanguard's 2024. How America Saves report found the median 401k balance for investors aged 45 to 54 sits around $185,000. 8% of that, using 7% in the conservative real return framing that I'll use throughout this video, which is the post-inflation average from the S&P 500 going back to 1926 per Shiller's Yale data, generates roughly $13,000 a year, just over $1,000 a month, from a portfolio that 5 years ago was generating 80. The number on the return line is the first instrument you should be watching. Not the total balance, that's the lagging indicator. The monthly return is the leading one. Sign number 2, a single bad year doesn't undo multiple good ones. This one requires a slightly different way of looking at your statements, and most people never make this comparison because no one tells them it's worth making. Pull up what your portfolio earned in its single best year in recent memory. Now pull up what it lost in its single worst year. If you've been investing for at least a decade with consistent contributions, there's a reasonable probability that your best year's gain in absolute dollars is now larger than your worst year's loss in absolute dollars, even if the percentage loss was steeper than the percentage gain. That asymmetry is a specific marker. At small balances, the percentages are almost irrelevant because the dollar amounts are small enough that both the gain and the loss feel manageable. A 20% gain on $15,000 is $3,000. A 20% loss on $15,000 is $3,000. Perfectly symmetric. Neither one fundamentally changes your life. At larger balances, the same percentage math produces something structurally different. A 20% gain on $200,000 is $40,000. A 20% loss on $200,000 is $40,000. Still symmetric in percentage terms. But here's the thing. If you've been contributing consistently while the balance grew from $15,000 to $200,000, your contributions over that same period added to the recovery every single month on the way back up, which means the next time you had a good year, the base it worked on was larger than it would have been if you'd simply sat still. The J.P. Morgan Guide to the Markets 2025 edition shows that missing the 10 best trading days in the S&P 500 over a 20-year period ending in 2024 reduced the annualized return from roughly 10.4% to approximately 5.5%. Those 10 days, out of roughly 5,000 trading sessions, account for nearly half the total return. The people who stayed in captured those 10 days automatically. The people who went to cash, even temporarily, very often did not. What changes as your balance grows is not the volatility percentage. Bear markets still hit the same percentage regardless of your balance size. What changes is your portfolio's ability to absorb that percentage loss and recover from it while your contributions are still running. At small balances, the portfolio is fragile. A bad year sets back the timeline meaningfully. At larger balances, the root system holds. The bad year hurts the statement. It does not uproot the tree. If you look back at your worst year in the last decade and it now feels like a speed bump rather than a near-death event, that shift in how it registers is not psychological maturity, it's arithmetic reality. Your portfolio has grown large enough that a bad year's dollar damage, while painful on the statement, is outrun by the recovery and the continued contributions within 18 to 24 months. That threshold, when your own history starts showing you that corrections are now recoverable inside 2 years, is a signal worth paying attention to. There's a specific name for the counterpart risk, and I'll come back to it in sign number 5. It's the one that catches people who cross this threshold and didn't realize it. And it's the most expensive thing that can happen to an investor who has actually done everything right. But first, sign number 3. Sign number 3. You've stopped thinking about your contribution as the whole plan. There's a specific mental shift that happens somewhere in the middle of a long investing journey, and almost nobody notices it when it occurs because it feels like a small thing. It's the moment when you stop mentally treating your monthly contribution as the engine and start treating it as fuel for something that's already running. In the early years, the contribution is everything. You feel it. If you miss a month, the account feels frozen. If you get a raise and don't redirect some of it, the portfolio doesn't move. You are the whole operation. The return is an afterthought, a small bonus that doesn't change the fundamental picture. At some point, that dynamic inverts. You open the statement after 3 months of not thinking about it, and the balance moved anyway. The market ran, and the number went up by more than you contributed. A flat income year, no raise, no bonus, and the balance still grew meaningfully without your help. This is worth quantifying. At 7% real annual return, the post-inflation conservative long-run average I'm using throughout this video, sourced from Shiller's data at Yale, a portfolio of $150,000 generates $10,500 a year in returns. $875 a month. If you're contributing $500 a month, the math has already flipped. Your contributions are 36% of the monthly growth. The portfolio generates 64% on its own. Your money is working harder than you are on a monthly basis automatically. The EBRI Retirement Confidence Survey from 2025 found that only 31% of American workers feel very confident they'll have enough to retire comfortably. A lot of that uncertainty lives in people who are still in the mode of thinking their contribution is the whole plan, because for a long time it was. The shift isn't psychological. It's a mathematical reality that's already true for more people than realize it. If your return line has been larger than your contribution line more than once in the past year, not as a fluke, you've crossed something. The contribution is no longer the engine. It's accelerant on a fire that's already burning. Sign number 4. You have enough that a fee finally costs something real. This one is a sign in a slightly different sense. It's not something to celebrate. It's something to fix. But it marks an important threshold. When your portfolio was $15,000 or $20,000, a 1% advisory fee cost you $150 to $200 a year. Annoying, maybe. Not structurally damaging. You couldn't feel the compounding loss. When your balance reaches $200,000, that same 1% costs $2,000 a year. Not in visible line items, but in compounding that never happened. At 7%, $2,000 grows to roughly $15,000 over 30 years. Run that fee for 30 years, and the real cost isn't $60,000 in direct charges. It's the stack of $15,000 opportunity losses that never appeared anywhere because they were absent, not negative. Morningstar's 2024 fund fee study found the asset-weighted average expense ratio for actively managed U.S. equity mutual funds sits around 0.65%. Compared to a Vanguard total market index fund at 0.03%, the gap is 0.62% annually. On $200,000, that's $1,240 per year redirected away from your compounding. Over 20 years at 7%, the cumulative cost of that gap approaches $50,000 in final balance. Not $1,200 a year. $50,000 total. The reason this is a sign isn't that fees suddenly matter more. They always mattered. It's that at larger balances, the dollar difference becomes large enough to turn vague intention into same-day action. When a 12-minute login and a fund switch inside your existing plan is worth $50,000, inertia loses. People act. If you've recently looked at your expense ratios and felt something closer to urgency than mild curiosity, your balance has crossed the threshold where the math makes the decision emotionally obvious. That shift in feeling is a marker. Sign number 5. You've started thinking differently about market drops. This one contains the most expensive hidden trap for investors approaching the point of no return, and the trap is almost perfectly counterintuitive. Her name is Lorraine. She's a 51-year-old ICU nurse in Tampa, Florida, earning $88,000 a year. She's been contributing to her hospital system's 403B since she was 32. Not perfectly. There were 2 stretches in her 40s where contributions got reduced, once for a roof, once for a year when her mother's care situation was unresolved and cash flow was tight. She doesn't pretend otherwise, but she kept the account open, kept something going in, and by last quarter her balance sat at $174,000. Lorraine has watched 2 significant market corrections since she started. The first in 2009 scared her badly. She didn't sell, but she came close. She stopped opening her statements for about 4 months. The second correction in 2022 was different, not because it hurt less on paper, It didn't. But at a higher balance, she could see that the dollar recovery would outpace the dollar loss within a reasonable window. She ran rough numbers during the drop and realized she was buying shares cheaper with every paycheck. The math of the correction had shifted meaning. That change in how a market drop registers is a real threshold. And here's where it gets complicated. The same shift that makes corrections feel manageable during accumulation makes them structurally dangerous in the early years of retirement. William Bengen, who published the original 1994 research in the Journal of Financial Planning that produced the 4% withdrawal guideline, built his framework around worst-case sequences, scenarios where bad returns arrive early in the withdrawal phase. His finding was explicit. A 30% portfolio decline in the first 2 to 3 years of retirement is not mathematically equivalent to the same decline in year 20. In accumulation, a bad year means buying at a discount. In the withdrawal phase, a bad year means forced selling at the bottom to cover rent and food. Those shares once liquidated do not participate in the recovery. Lorraine has 14 years until she's 65. Every bad year between now and then is still a discount. The change in how she reads corrections is an accurate read of her position. But the flip will come. Somewhere between 58 and 62, the math changes. And that transition requires building a specific buffer, roughly 1 to 2 years of living expenses in short-term, low-volatility assets before the withdrawal phase begins. Not because the market is going to crash, because if it does, she needs a way to live off something other than forced liquidation while the portfolio recovers. The sign is this. If market drops now feel like an inconvenience rather than a catastrophe, if you've started calculating recovery timelines instead of panicking, you are close enough to the point of no return that it's time to simultaneously recognize that shift and start designing the exit structure. Those two things happen at the same time. The confidence is earned. The planning is now. Sign number 6. The math on waiting has quietly inverted. Most financial urgency messaging is aimed at young investors. Start early. Time in the market. Every year of delay costs you. Accurate. But what almost no one explains is that the urgency math eventually runs in both directions at once. Earlier in your investing life, the cost of delay is front-loaded. If you wait 1 more year to start, you lose 1 year of compounding on every dollar you ever contribute. At 7% over 30 years, that 1 year of delay roughly doubles the value of a year's contributions in lost compounding. At a certain portfolio size, a second kind of delay cost appears, the cost of waiting to optimize. Say you've been in an actively managed fund charging 0.8% for the last decade. You've been meaning to switch to an index equivalent at 0.05%. At $150,000, waiting another 12 months costs you approximately $1,100 in fees that will never compound, not over the life of the portfolio. In the next 12 months alone. The same logic applies to tax structure. EBRI data from 2025 shows that among workers with access to both traditional and Roth options in employer plans, roughly 60% default to traditional without modeling the tax treatment of withdrawals. At small balances, the decision is genuinely close. It hinges on current versus expected future bracket. At larger balances, particularly when the portfolio is generating $15,000 or $20,000 a year in returns, the tax-free compounding of a Roth account starts producing asymmetric outcomes that a traditional account can't match. 40 years of compounding at 7% with no tax drag at the end is structurally different from 40 years of compounding with a 22% federal tax applied to every dollar you withdraw. When you start feeling that urgency, when you look at a fee structure or a contribution allocation and feel something tighten, a sense that every month unchanged is a month you're paying for, the portfolio has grown large enough that percentage decisions now produce dollar amounts that matter. That tightening is not anxiety. It's an accurate read of scale. Lorraine, for what it's worth, was in a target date fund charging 0.48%. Not egregious, but not nothing. Moving to a lower-cost index alternative inside the same plan takes about 20 minutes and, over her remaining 14 years at her current balance, is worth approximately $19,000 in final balance. She made that switch 6 months ago after an afternoon with the fund detail tab open. The delay hadn't been stubbornness. She just never had a reason to feel the urgency until the balance got large enough that the math became personally offensive. Sign number 7. The frustration has changed shape. This is the most subjective sign on the list and also the most reliable one. Pay attention to it. Early in an investing journey, the frustration is elemental. Why is this taking so long? Why is the number still small? Why does it feel like nothing is happening? That frustration is directed at the pace. The process feels slow because it is slow, genuinely mathematically slow at small balances, and the human brain was not designed to find meaning in a number that moves 2% per month. But at a certain point, the frustration changes shape. It stops being about the pace and starts being about the waste. You're not annoyed that the portfolio is growing slowly. You're annoyed that you were in a high-fee fund for 4 years before anyone told you. You're annoyed that nobody walked you through the Roth conversion window in your lower-earning decade. You're annoyed that the default contribution rate your employer set you up with was 3% of salary, which is the minimum to get the match, which happens to be the exact number that keeps you in phase 1 for 2 extra decades. The frustration has moved from the progress to the drag on the progress. That shift matters because it tells you something about where the math has gone. You don't get upset about fee drag at $20,000 because $20,000 doesn't produce enough return for the fee to feel real. You get upset about fee drag at $180,000 because at that balance, 0.75% is $1,350 a year. Real money, visible money, money you can calculate the compounding loss on in about 45 seconds with a phone calculator. The frustration became specific because the math became specific. And the math became specific because the balance became large enough to make the percentage feel like a dollar amount. This is worth sitting with for a moment. The thing that changed isn't your intelligence about investing. It isn't your discipline. The thing that changed is the scale of the pile, which changed what the percentages produce, which changed what the errors cost, which changed how the errors feel. And here's where the anti-diagnosis lives, the thing this whole video has been building toward. Most people who are approaching the point of no return think the problem is they got here too slowly. They look at the balance and calculate where they'd be if they'd started 5 years earlier, contributed $200 more per month from the beginning, avoided the one fund switch they made in 2018 that cost them 9 months of recovery time. They run a grief calculation on the past. What they miss is that the question has changed. In the early years, the primary question is, how do I get the balance large enough for the percentage to matter? That's a contribution and consistency problem. The answer is boring and specific, more in, less out, time. But at the threshold, when the signs I've described are present, the question flips. The primary question is no longer how do I grow this? It's how do I stop losing pieces of it to avoidable drag, fees, tax inefficiency, behavioral timing errors, the sequence risk that arrives at the transition to withdrawal. The enemy changes, and if you keep fighting the old enemy, trying to contribute more, find a higher return fund, squeeze out more percentage, while the new enemy is quietly extracting percentage points through structure, you can win the contribution battle and lose the wealth war. The behavioral research supports this asymmetry. The J.P. Morgan Guide to the Markets 2025 edition includes a long-run chart comparing equity fund performance against investor returns captured after behavioral timing decisions. The gap tends to widen as portfolios grow, not because investors get more emotional, but because the dollar cost of each emotional decision gets larger. A panic sell when you have $30,000 in equities might cost you $2,000 in missed recovery. The same behavioral error with $200,000 in equities costs $14,000. Same percentage error, 7 times the dollar damage. The math of mistakes scales with the portfolio exactly the way the math of returns does. What this means practically is that the skill set required to reach the point of no return is not the same skill set required to benefit from it. Getting there takes contribution discipline, inertia, the kind of patience that lets you ignore the account during bad years. Benefiting from it takes structural attention, auditing what the portfolio costs, designing how you exit, building the buffer that protects the compounding from forced liquidation. One is a habit. The other is an engineering problem you solve once and don't revisit often. Most people apply the first skill set forever and never pick up the second one. Now Lorraine. She has $174,000 at 51, 14 years to 65, and the frustration that has changed shape. The slow-moving impatience she felt at 38 is gone. What replaced it is a very specific irritation that her 403B defaults kept her in a fund she'd have never chosen if she'd been given 30 seconds of real explanation at enrollment. She fixed the fee situation. She's now looking at two other things. First, she ran the sequence of returns math on her own situation using a basic retirement calculator. At her current savings rate, she'll have somewhere between $380,000 and $420,000 by 65, a range, not a precise number, because the sequence of her annual returns between now and then is unknowable. What is knowable is that if her first 2 years of retirement coincide with a significant market decline, and she immediately draws down at 4% without a buffer, the Trinity study data suggests a meaningful probability of running short before 85. If she enters retirement with 18 months of living expenses in short-term treasuries or money market funds, the same portfolio survives that scenario comfortably because she doesn't touch the equity portfolio during the decline. She builds the buffer. She gives the compounding time to recover before she starts drawing on it. Second, she looked at her tax structure. She's been in a traditional 403B her whole career. The conventional logic said traditional made sense because her income was highest now and she'd be in a lower bracket in retirement. She ran the actual numbers. At her projected balance, required minimum distributions starting at 73 would likely push her into the 22% federal bracket anyway. The lower bracket assumption isn't guaranteed. She's now contributing the maximum allowed, $23,500 in 2026, and routing the full increase into the Roth 403B option her plan added 2 years ago. She's not converting the existing traditional balance, which would trigger a tax bill she can't absorb now. She's just directing new money into the tax-free structure for the remaining 14 years. 2 structural decisions. Neither required discipline. Both required reading a document and making a one-time choice. And that, actually, is what the practical takeaways look like at this stage. Because I want to be specific here rather than generic. If you're seeing multiple signs from this list, the next moves are specific. Not a generic checklist, but decisions calibrated to this exact stage. First, pull your actual monthly return number from last month's statement, not the total balance, the return figure from market performance only, and compare it to your monthly contribution. If the return is more than 50% of your contribution amount, you are close to or past the flip point. Write that ratio down. Then calculate what your monthly return will be when the ratio hits 100%. When returns match contributions dollar for dollar. That's your personal crossover date. Find out when it arrives at your current trajectory. It will be sooner than you expect, and knowing the date gives you a concrete reason not to interrupt the process. Second, if you haven't audited your expense ratios in the last 12 months, do it this week, not this month. Log into your account, find the Fund Details tab, look for the expense ratio column. If anything is above 0.4%, check whether a comparable index fund exists inside the same plan. In most employer plans, it does. Switch it. The cost of one more month in the wrong fund is calculable. It is not a small number at your balance. Knowing the specific dollar figure, running the 30-year compounding cost of the fee gap, is usually enough to eliminate the procrastination. Fourth, if you are within 10 years of your target retirement date, design your withdrawal buffer now, not when you retire, now. Identify the specific amount, 12 to 18 months of anticipated living expenses, and build a plan for accumulating it in short-term, low-volatility instruments in the 3 to 5 years before you stop working. The sequence of returns risk I described with Lorraine is not theoretical for investors at this stage. It is the concrete mechanism by which a well-built portfolio can fail to deliver what 40 years of discipline produced. The buffer is not a sacrifice of returns. It's the structural decision that lets the compounding run to completion. If you've been subscribing to the idea that the whole game is contribution, discipline, and patience, you're not wrong. You're just working from a framework that was accurate in phase 1 and is now incomplete. The root system is there. The tree is real. The question now is whether the harvest goes to you or to fees and taxes and a badly timed first year of withdrawals. Lorraine checks her balance quarterly now instead of the anxious daily checks she used to do in her 30s. Last month, the return line was $912. Her contribution was $625. She didn't write it down or celebrate. She just noticed the ratio. and she understood what it meant. If you found any part of this useful and want to keep getting analysis that actually names the mechanism behind what you're feeling, subscribing is the most direct way to stay connected to this kind of content. I cover these frameworks regularly, and the algorithm does not reliably surface them to people who haven't subscribed. The roots are there. Most people just never learn to look for them.